I are not part of this auction,
Right.
we get that same level. So everybody in the world gets paid the same interest, and that's it. So we get 2.4% for $100
Did you ask them about that one?
No, so basically now they're having this going on, like a stock. What do you call it? The treasury,
bonds,
the
the
bonds,
bonds.
and the auction.
We've been looking them up.
Oh, did you get treasury bills?
Well,
Bills, not bonds.
Treasury bills.
so, right, so she looked it up.
I
and-
looked it up, and now it's going auction for 2.4.
There you go.
But it end on the 24th. So
Exactly.
the question is, do you have to pay tax on the
You pay
interest?
tax on the interest,
You
right?
Like-
pay tax on the interest, but not state tax.
Oh, okay.
So,
But it
yeah.
wasn't $50,000.
It's like $50,000.
No.
Treasury
not?
bill is 100.
Oh.
One treasury bill, not bond.
Oh.
Treasury
This was,
bill.
It was
what
like-
was it?
Let me ask my.
It's $100 minimum.
Well, this, I
Minimum.
guess, I guess
So
he
you can, like-
thought if it was 50,000 for the 1 month, he'd make $1,200.
Okay.
No, not 1,200. That's a year. Sorry. And like, so it's like.
It's a year, yeah, the interest is
So
only
your
yearly.
$50,
basis.
you will make like 100 something.
Yeah, at any rate,
Oh,
it's,
yeah,
it's a
yeah,
treasury
something like that,
bill.
But it's still,
Yeah, still.
Okay, I left
Yeah.
you this little piece of paper.
Did you do it or you didn't? I'll get there.
As it turns out, Harvard just started this year a course on personal finance.
hello?
And
Hello?
they did that because of all the kids struggling with the same problems we're struggling with. And of course, they have a lot of debt. So this is the website. You go online, play around. You can see the agenda that they have. A lot of the same stuff we do, talk about. It's a 6-week course, something like that, at Harvard. It's an optional economics course
Wow.
on personal finance at Harvard. So I thought you might be interested in take a look.
So this is for, I'm sorry, I'm gonna go backwards.
Okay,
You
go ahead.
said bills, not.
Bills. Did I say bonds last time? Everybody's got confused, so I don't have to make sure of that.
Okay.
Treasury bills, bills.
Treasury bill.
Okay, couple things from last week. What we talked about is obviously start saving now. Compound interest makes a huge difference, this is why you start. And if you go to, if you look at back on page 7, where we talked about the 3 levels of where you can invest for cash, savings accounts, and investment. Let's talk about a second where that 3 years comes from. And let me give you this piece of paper. What this is
Thank goodness.
what this is a look at the fiscal crisis that we had in 2008. Because there's a lot we can learn about that.
Yeah.
So here, there's a little bit of a write-up about the fiscal crisis. Lehman Brothers went bankrupt. The head of Treasury was on television every day. They really thought that things were going to fall apart in the world financially because everybody gambled somebody else's money. And they bought things they didn't know what they were buying, and the housing was collapsing and falling apart.
They were
Okay.
giving out mortgages that they shouldn't have been.
Exactly right. And by the way, I knew that. Brian called me up 2008 and said, "Dad, I can buy a house."
Yeah, and then you said, oh,
I
now,
said,
now the world is.
"No, I didn't know." I said, "What?"
Really?
I said, "Brian, you're not making that much." He says, "Well, the broker said I don't have to put anything down."
That's right.
Now,
The interest.
had I really thought about it, I would have said, "Oh my God, this is," of course I didn't, but that was going on. Anybody can buy a house. And, okay, so
They were
let's
really-
look at this chart. Now this chart is just for stocks, the S&P 500 index, and we'll talk about that later, but it's just the top 500 stocks in this country. So it's a good indication of what the stock market is doing. So in 2000, and it's just a relative number, 1,400 is when it was at in 2008, okay? The beginning,
Uh-huh.
with me? And then you can see what happened during 2008. Now, here's what happened. If you were retiring in 2008, and that's a lot of people, right?
Yeah, it was.
And you needed the money to live on from your retirement, right? A lot of us are going to do that. What do you think happened to these people?
They didn't have enough money.
It was horrible.
So they woke up every day and they looked at something or other and saw that the value of their portfolio was doing what?
Down.
It
Right.
was
Now,
crap.
now, you know, you go in and get up the next day and it happens the next day. Meanwhile, you probably haven't sleepless nights, right? You've worked your whole life, you saved your money.
Yeah.
Somewhere along that curve, that downward curve, you say, I can't take it anymore, right? I'm losing, because that curve dropped nearly 50%. So what do you think they did?
They took their money out.
They started
They took their
crying.
money out.
They moved to Costa Rica.
They moved to Costa Rica and took their money out, exactly. So, and then, to make matters worse, they not only lost a lot of money, but they thought they learned some lessons. Now, we all know that we learn from mistakes we made,
Right.
but you gotta learn the right lesson. What they learned was, what they thought they learned was, stock market is too risky, I'm never gonna do that again, I'm not gonna put my money in there. And so they got a double whammy, because what happened when it reached the bottom? It
goes up again.
shot right up. And so there were statistics that showed, and we're all called retail investors. There's other investors called institutionals, like hedge funds and Hopkins and Harvard and all that kind of stuff. The number of retail investors dramatically has decreased since 2008. Because all these people said, it's like Las Vegas, I'm not putting my money in the stock market again. What didn't they do?
Buy?
They didn't do anything with it, they just took it
Well,
out.
what they didn't have is 3 years of cash before they retired. Because if you have 3 years of cash, you don't have to
Kind
Panic.
of,
sell.
yeah.
If you buy a handbag here for $100, you love it, it's a beautiful handbag. You walk out, you come in next week for hair coloring, and it's now $90. It's a beautiful handbag. Have you lost $10?
Yes.
You got your handbag? Have you lost $10?
No.
No.
Oh.
Then you come back the following week, it's now $80. Have you lost $20?
No.
You say, well, I wish I would have bought it now instead.
Right,
of...
right.
You haven't lost any money because you still got the...
Handbag.
Right.
So when the market goes down, have you lost money if you
No.
haven't sold it?
Right.
But you
No.
could have buy it for cheaper.
What? Yeah, manana, yeah. Of course you can, yeah, but you don't know that. Nobody knows.
true.
Okay, so the truth is you don't lose money in the stock market unless you
Sell it.
sell it. Okay, so if you have enough money that you don't have to sell it, then you're okay. So, two things happened. The number of people who got out of the stock market was dramatic and never got back in, and I'll show you in the next piece of paper, and they didn't have the cash to weather the storm. And that's where 3 years comes from, because if you kind of look at that chart, it takes about 3 years to recover. And
Yeah.
by the way, this was the biggest downturn since the Depression of '29.
Yeah,
That took place that Harvard has a finance program.
It shouldn't have been a shocker, though.
In what sense?
I mean, that they were loaning people money that couldn't really
Yeah,
afford it.
in retro, exactly.
In a way, it was really,
Exactly.
it was almost,
Predetermined.
yeah, predetermined, but it was also very provoking of human beings.
Exactly.
Like really playing on them.
Absolutely correct.
Predatory.
It's absolutely
It was
predatory. And when
predatory.
Brian, my son,
Yeah,
calls me up and
so
says,
predatory.
who has hardly a job, that I can afford to, yeah, exactly. Okay, take a look at the other side of this piece of paper.
Uh-huh.
Now, the first chart is a hypothetical chart. And I don't know where I just picked,
Yeah, he just
here,
handed it out.
I'm sorry, here you go. Yeah, yeah. So I just picked $250,000, it could have been 25,000. And this starts in 2009, which is at the recovery time, right? Look what happens if you invested $250,000 in 2009. How much money would you have in 2008, in 2019?
Wow, million.
You'd have $1 million.
Wow.
That's it.
So if you did nothing, nothing, and if you invest a little bit, like $200 a month or something, you get the red line. And finally, the last
That's
thing.
with 12.5% growth.
Well, that's what happened.
Oh, it did?
Yeah, this is real.
I'm wondering.
This is real. That
How come
look at
mine's not a
that
million?
12.9% growth really
I have my paper.
really
You
happened.
do?
And finally, look at the last
The other day, so I brought it.
look at the last chart.
When did you have it since?
Now, here I am sitting in my house in 2008, right? And I know I'm not selling anything. All right? What kind of phone calls am I getting from all my friends? Including my daughter. What kind of phone calls am I
I'm
getting?
losing money. Can I take it out?
What should I do? Should I sell now? And what do you think I said?
No.
So I'm sitting there saying, no, things are cool. Sit tight. You're okay.
Right.
So I'm saying, you know, Dave,
Live with me if all.
what-
It's hard to see the
Well, I
number.
gotta also tell you, my anxiety about this from a scale of 1 to 10 is like 1. But that isn't everybody.
No.
And some of my friends I know are really anxious, and they're calling every 4th day. And so I know it's all anxiety. It's not math, and it's not spreadsheets, and it's not charts. It's anxiety. Okay. So they're in a different ballgame, and you got to sleep at night to sort of get through life. So I'm saying to myself, you know, Dave, what I should be doing. There's 3 choices. You can sell, you can do nothing, or you can
Right.
buy. So I'm saying, okay,
Is that a good
let's
time
try and experiment to myself.
Right.
I'm going to start buying. So I opened up an account just for this issue. It's not part of my long time portfolio. So I opened up an account at Dodge & Cox, which is it's a mutual fund. And I decided to put some money in the Dodge & Cox in 2008 and put in $200 a month and see what happens. That's all I wanted to do. Now, at that time, what was the stock market doing?
Down.
Down. I had no idea when it's going to end. None.
Right.
Now, as it turns out, it ended not shortly after I started doing this. Who knew? Okay. So this is my chart. This is my portfolio of this one account. And on the left-hand chart is the value of that one mutual fund. $60, $80. And look what it did.
Wow.
And look at how much money I made from 2008 to 2011. It averaged 14.4%. And I sold it because it was just
Right.
to see what would happen, and I just sort of got out of that. So, moral of the story is pretty clear, right?
Don't touch it.
Invest in stock, don't touch it, have enough money to weather 3 years, and that's where the 3 years are.
Yeah.
Okay. All right.
So invest in stock.
For the long term. For the
We
short
talked
term.
about your portfolio. I think it needs a little bit of a definition. When we talk about like balancing your portfolio, it's all your assets, your retirement account and whatever assets you have. If you have other stocks and bonds other places. If you're living with a significant other and you intermix your funds, it includes his account also. So it isn't my account, his account. Now, I have friends who've been married 22 years and they keep their money separately. Then it is his and hers. But if you commingle your money, then it's a joint kind of a planning for your portfolio. And just one other thing I just casually mentioned, I strongly suggest that you open up an investment account at Schwab. I don't work at Schwab, I have no relatives in Schwab, I don't have stocks in Schwab. But I've been with them for 25 years, and they're fantastic. They're the leader now in investments, and in terms of lower cost and customer service. And in fact, when Schwab reduces the cost of buying and selling a stock within 4 hours, Fidelity, which is huge, does the same thing. So Schwab is, I mean, you walk into a Schwab place and there's a bunch of them around town. Somebody's there to say, hi, how are you, how can we help? I mean, they're just a great
There's one in Park Potomac, but they.
One in Potomac Park.
Works in Bethesda.
Okay.
one in Bethesda,
There's one in
right at
Powell.
East West Highway. It's free parking, I mean, everything is
Is it a
just.
bank?
It's not a
Okay,
bank, it takes
um,
no money, it's an investment.
So, let's talk a few minutes about stocks. What is a stock? What do you think? What is a stock?
They took your money, invest. In, like,
Okay,
different-
what is the stock though, do you know? It's ownership of a country, of a company.
Okay.
You actually own part of a country. So if you buy one share of Coca-Cola, you own 1/billionth of,
We're like, I don't
or so, depending on how many stocks there are.
Right.
If there's 20 million stocks out on Coca-Cola, you own 1 divided by, what do you mean? Now, you can't walk into the Coca-Cola store and say, give me a bottle, I own this place. You know?
Right.
But
Why not?
you're due 1/20 of the assets that it has, okay? So what is a stock? It's ownership of a country, of a company. Okay, let's turn to
Wanting to
page,
say country.
turn to page 15, and let's see how stocks get started. And I just made up this little thing about progressions, page 15. Okay, so, progressions own this place, right? Now, why would they want to issue stock?
They wanna put money in the company?
Okay, and why would they want to put money, why would Cindy want to put money in the company?
What page?
15.
To build it, to have more cash flow?
Or to expand.
Expand, okay.
So, she can get a lot of money with selling stock. So generally, she'll have this place, and she'll have one in Rockville, and one in Arlington, and she's got 4 of them, and she wakes up one day and says, you know, this is really going great. I want 20 more. I want 30 more over the next 4 years. I need money to buy, rent, hire, and everything else. So one way, a significant way that companies get money is issuing stock, okay? So I just wrote down here, kind of give you a sense of how that would happen. The progression wants to go nationwide, okay? Cindy meets with a consultant who can help her determine if people will buy stock in a place like Progressions. And there's experts out there who know that kind of stuff, right? And they'll say, you know, 5 hair salons tried it in the last 3 years and it didn't work, and you're not, or 3 of them tried it and your numbers look so much better than the other 3. It makes sense. So there's a whole set of discussions about whether it makes any sense. Okay. Then there's people called underwriters to determine how much money she could raise. You can't say, I want $20 gazillion, because if that kind of money, people aren't willing to spend that money to buy this stock, then it's a useless number. So there's experts out there who can help companies like this determine how much stock to issue and what is the cost of the stock. You got to go through the Security and Exchange Commission. It's a really formal thing. You just can't do it by the seat of your pants, okay? Then what Cindy does is get on an airplane. And she goes around to all the big people, all the hedge funds, maybe the universities, I don't know who, and she makes a presentation. And the presentation is, let me tell you about my company, this is what we've done, this is how much money we make, here's my progressions, here's my competition, all kind of stuff. Because why is she doing this? What do they want, what does she want them to be able
Buy
to do?
stock.
Huh? Buy the stock. When she finally issues them, she wants a demand for people to buy the stock. Okay. The day of the public offering, the underwriter The underwriter purchases all the stock. I didn't even really know that, but it's a detail, but it's interesting. So purchases, okay, and then when it goes public, the people like you and me can buy the stock, and who are we buying it from?
The underwriter.
The underwriter. Now, after all this gets done, the next day, the next year, when you're buying and selling a stock, are you buying and selling it from Progressions?
No.
Who are you buying and selling it from?
People that own the stock?
Yes. So tomorrow you can buy a share of Apple stock. You're not buying it from
Apple.
Apple, you're buying it from.
Someone that
traders.
sold their stock.
Okay. So that's sort of the sense of.
Because there's only so much stock out
Yes.
there in
Right,
the world.
right.
There's only so many issues. There's 20 million, say 20 million shares of stock. That's right. And what causes the stock to go up and down?
What causes the stock to,
How
The
well
price
the
of the
company
stock.
does?
yeah,
That's-
how well the profits
But
are.
fundamentally, it's supply and demand, right? If everybody wants Progression stock, price is going to go up. If everybody,
Yeah.
just the opposite. Okay, so I got some things here that let's talk about internal events that cause the stock to go up and down. Every company, most companies, not legally, but most companies issue quarterly reports. This is how well we've done, this is how much income we've had, and what do you think, are there people who desperately watch these quarterly reports? You
Yes.
bet.
Of course.
And if it looks good, it goes up, if it looks bad.
So it's kind of like Tesla. If Elon Musk is talking out of his, it's gonna go down.
But that's not the quarterly report. They know they're losing money. Amazon's losing money, Tesla's losing money, Uber's losing money. They're all losing money.
Right.
Stock still could be going up, though in Uber's case it's going down. I don't know. Yeah, but the quarterly report is just one
Snapshot.
internal event that causes stocks to go up and down.
Okay, so Dave, let's say Uber stock goes all the way down.
Yeah. If you own it, that you've lost money.
Okay,
If you
so.
sell it.
Okay, so,
I'll make you sell it.
right,
Yeah.
okay.
Its value's gone down, but it could turn around the next quarter
Good.
or the next
Unless you
year.
think it's going to
Right.
stay there forever, and then in which case you should get
Right.
out and
Right.
do something else.
You just keep watching it
Yeah.
through the quarters.
They also project future earnings. So not only do they say, this is how we're doing, they say, based on future earnings. So that is also a signal to people whether to buy or sell a stock. Analyst expectations. You see the Wall Street Journal, some big company signed on with General Motors to buy 50,000 cars. What's going to happen with the stock? Go up, right? CEO goes to jail. These are internal events. What do you think the stock does?
Down.
Plummet, baby, plummet.
FDA approves a new drug.
Up it goes.
FDA disapproves a drug.
Oh, that sucks.
New product announcement, mergers, breakup, all of that kind of stuff. Okay, how about external events? Yesterday, Trump walked out of the meeting with
Yeah.
Pelosi. What do you think the stock
3
market's
minutes.
doing today?
Shake it.
It's going down. Why? What were they going to talk about?
Transportation.
Infrastructure.
Yeah,
What does infrastructure mean?
the roads.
Building, roads, money, jobs. So what do you think the stock market, I don't know. What do you think the stock market's going to do today? It's going to go down because people are getting nervous that whatever their thinking was about this stuff isn't going to happen.
But that goes into your emotional.
I'm sorry, I can't.
That goes into your emotional.
Of course, it's all
buying.
emotion.
Right, okay.
It's all, you're all, by the way, 90% of all the stock is owned by institutions.
90%. Wow.
Yes.
That's a lot.
And guess how they buy and sell? They don't have people
Board
sitting.
meetings.
Well, no, computers.
Oh, computer.
So they've hired my grandson,
That's
Okay.
right.
who sits in a little something or other for the last 3 years saying, if this happens, and this happens, and this happens, and this happens, and we have this, I think we ought to be able to sell. And Harvard's doing that, Hopkins doing that, hedge funds, they're all computer driven. Do they have the same algorithms? Who knows? Probably not, because it's proprietary, so they wouldn't do that.
It's very
So-
interesting.
So they're all sitting around with these software programs that automatically, remember when they issue a quarterly report at 10:03, they're buying and selling at 10:03.26.
Okay.
Mm. Okay,
Doesn't that make it harder to follow?
no, you don't have to follow. I don't care
That's the
about it. I'm
institution.
telling you how it
That's
works.
not- that's-
None of this is relevant to what I do.
Right.
I read the paper every day and I say, okay, today's going down. And I close it up and I
Right.
look at the sport page. First I look at the sport page. And I say, oh God, they lost again. Then I react to that. I look at the Wall Street Journal, I have no reaction. Zero, zippo, none. I just want to know. And when I know, I close it up and I do something else. So I have no reaction to whether the stock goes up or goes down. I could care less about what my grandson wrote as an algorithm for when he should, I don't care about that. In fact, I think I'm better than my grandson's algorithm. I don't care. I don't care, and we don't care. And I want to go through all this to show you the underpinnings of the kind of stuff we're going to be doing. But I'm not at all suggesting this is relevant for you. Major political upheavals in this country, stocks go down. Why do they go down? Because these companies want to understand what's going on. They like certainty. And when the world is uncertain, having trade wars with China, it's uncertain. They don't know the consequences. So if you don't know what's going on and you really care about that, how are you going to buy or sell? You're going to sell. We just get nervous. And these software programs sort of get nervous. Okay. Now, one thing we haven't talked about is inflation. How important is it to just know about inflation?
Very.
Why?
Because it's the final bottom line of your financial well-being.
Okay? If inflation goes up 2% every year, sort of what it is, what happens to the value of your portfolio if it stays the same?
You
You're losing.
lose
How much?
2%.
2%. So, if you do nothing, you're going to lose 2% every year. It's not always 2%, and you don't, your world doesn't, you don't necessarily get hit every day, every year with a 2% increase in cost. If you have a mortgage, it doesn't increase 2%. But in general, it'll drain your portfolio. So by investing at 2%, you're doing what?
The balance in it.
Staying even. Are you growing anything? No. That's why people are in stocks and bonds. It's okay to get T-bills to park money for short term, that just keeps you even. But in general, you can't keep even unless you're in, now you can do some other exotic things, but for most of us who aren't in these exotic things, we get in the stock market because that's greater than inflation. Okay. And what happens to stocks if inflation goes up?
You make money. You make money?
Well, what happens to companies? Well, let me go back.
You're not-
Does the stock market generally go up or down when inflation goes up?
Probably down.
It goes down. Why? Well, as it turns out, the government does studies about the cost of things every month or quarter.
Ready?
Okay? And so why would the cost of progressions cost go up?
Because
But
it's
you have to pay.
service oriented.
Service oriented, what is one of your biggest expenses?
What is one of the payroll?
Payroll.